So in continuation of our previous discussion, in this class we are going to learn something about clean price and dirty price. Clean price and dirty price. Now here I don't want you people to have mechanical understanding. I want you to be extremely clear with what is clean price, what is dirty price, how each of these prices are determined. Let us take an example. Say there is a bond which makes coupon payment annually. So there is a bond that makes coupon payment annually. Say every December the bond makes the coupon payment, every December, that is 31st of December at the calendar year end. Let us assume that today is 31st of July. Today is 31st of July. So do you know, previous 31st December the last coupon payment would have been made, yes or no? Previous 31st December the last coupon payment would have been made. Now assume that you are the holder of the bond and in the secondary market I want to buy this bond from you. I want to buy this bond from you. You are the existing holder of the bond. Now I am buying bond from you not at the coupon date. I am buying bond from you at an intermediate date which is not a coupon payment date. Possible or not possible? See, bond buying and selling will happen every day in the secondary market. Every day bonds will be bought and sold. Correct? But coupon payment will be made by the issuer of the bond only once in the year if it is annual coupon payment. If it is semi-annual, that is half yearly, then coupon payment will be made twice a year. Right now in my example, I have taken annual coupon payment bond. If it is annual coupon payment, only once in a year the coupon payment will be made by the issuer. And in my example, it is 31st of December. But today, on 31st July, I want to buy this bond from you. Now logically, in the current year, January, February, March, April, May, June and July, 7 months you were holding the bond, correct? And from August onward, I am the holder of the bond. August, September, October, November, December. Logically, the interest for this current year, logically, you should be getting 7 months interest and I should be earning 5 months interest. Yes or no? Tell me. Yes or no? Logically, because you have been blocking your money for 7 months, I will be blocking my money only for 5 months. But understand one thing, the issuer of the bond is not going to make these adjustments. Issuer of the bond will look into one thing, that by end of the year at the coupon payment date, who is the holder of the bond? If I am the holder of the bond, entire annual coupon will be paid to me. That is why on 31st July, that is somewhere during the year, which is not a coupon date, if I am buying the bond from you, I have to pay you two things. Number one, the worth of the bond, the price of the bond. And number two, what I have to pay to you is interest that has accrued for you from January to July. That is 7 months interest I should pay to you. Correct? 7 months interest I should pay to you. Terminology that are used in the bond market, you should be very clear. And the real life facts you should be knowing very well. Bond prices quoted in the market are never with interest accrual. These are purely the values of the bond without any interest accrual. The price of the bond which is without any interest accrual is the real value of the bond as on that date. That is called the clean price of the bond. Price of the bond which is inclusive of accrued interest is known as the dirty price of the bond. First, by nomenclature, you should understand what is the meaning of clean price and what is the meaning of dirty price. Could you follow what I said? What is clean price and what is dirty price? Clean price is such a price of the bond which does not include any interest accruals. Dirty price is the price of the bond which is including the interest accrual from the previous coupon date till the date of bond being purchased or sold. Use your common sense now. Which price will be greater than which price? Obvious thing, right? Obvious thing. Which price will be greater? Dirty price will be greater than the clean price. Dirty price will be greater than the clean price because dirty price is inclusive of the clean price plus the accrued interest. Now, also look into what are the other names. Clean price is also known as flat price. The other name for clean price is flat price, whereas the other name for dirty price is full price. Flat price, full price. So you may use the terms flat price and full price. Flat is clean, full is dirty. Are we clear with that? Now, please understand one thing. In real life, how do you make the computation? You don't ever make computation by taking the calculation of clean price first. Clean price is never computed first. What is computed first is the full price of the bond. That is the dirty price of the bond. That is computed first. And then the interest that has got accrued from the previous coupon date till the date of purchase, that accrued interest is then subtracted from the full price to arrive at the flat price. So you will first compute the dirty price, then you follow the equation that clean price equals to dirty price minus interest, and that is how you arrive at the clean price or flat price. So be clear what happens in reality, what happens in bond market. You should be well versed with that. So let us do one thing. Let us first write up some notes over here. The clean price of a bond is the price quoted in the bond market which does not include any accrued interest. It represents the bond's value based purely on its coupon payments and principal repayment, ignoring any interest that has accumulated since the last coupon payment. The dirty price, also known as full price or invoice price, is the bond's price that includes accrued interest. It is the total price that the buyer pays to the seller, encompassing both the clean price and the interest that has accrued since the last coupon payment. Alright friends, once you have completed writing this much, let us move ahead and continue writing further. Accrued interest, flat price and full price. So far we have been calculating bond values on the date a coupon is paid as the present value of the remaining coupons. For most actual bond trades, the settlement date, which is when cash is exchanged for the bond, will fall between coupon payment dates. Bond pricing has to account for the fact the next coupon will be paid to the buyer, but a portion of it, the accrued interest, is owed to the seller. The accrued interest since the last payment can be calculated as coupon payment into days from the last coupon settlement divided by days in the coupon period. Alright friends, once you have completed writing this much, let us move ahead and continue further. Bond prices are quoted without accrued interest. This is because holding yield constant, including accrued interest, would make a bond's price appear to increase on each coupon period and drop suddenly on the coupon payment date. So I believe that you understand what is included in this paragraph. Just imagine that instead of clean price, if you start quoting dirty price in the market, gradually with every day's interest accumulation, the bond price will go up. On the coupon payment date, once the coupon is paid, suddenly the price will come down. Now, the price fluctuation now because of the interest will confuse the investors. They will believe that yes, the value of the bond is growing, which is not appropriate. They should always be aware of what is the true value of the bond quoted in the market today, and that is why it should always be without any accrued interest. Accrued interest you can always calculate separately and adjust it. So when in between dates, when a particular investor is selling a bond, that investor will recover definitely the accrued interest. Investor is not going to compromise with that. Investor has blocked the money up to that date, so investor will be recovering that interest portion from the new holder or from the buyer of the bond, definitely. But in the bond market, the price of the bond will not include accrued interest. But as I told you, the right approach of computation, what is adopted in the bond market, it is arriving at the full price first, from that subtracting the accrued interest to arrive at the clean price or flat price, which will be then quoted in the market. So a bond's quoted price is known as its flat price or clean price. Three terms given: quoted price, flat price, clean price. All resemble the same thing. And the other terms are full price, invoice price and dirty price, that represent the price which is inclusive of accrued interest. So term wise as well as the meaning wise, you clear with this whole thing, right? Alright friends, once you have completed writing this much, let us move ahead. However, we cannot simply calculate a flat price and add accrued interest to it. Instead, we must calculate the full price and derive the flat price from it. So flat price is full price minus accrued interest. The method for calculating the full price is as below. Step 1. Calculate the value of the bond on the last coupon date and compound this value at the YTM per period over the number of days since the last coupon payment. After these two steps, you will be getting the full price of the bond. Then compute accrued interest and subtract the same from the full price to arrive at the flat price. Mind it, these steps are not designed for computing the flat price. These steps are designed for computing full price. Once you get the full price, from that you subtract the accrued interest and you arrive at the flat price. Alright friends, once you have completed writing this whole thing, let us move ahead and take up an example to understand this whole concept. Now, this is a very, very important example. I want everyone's complete attention over here. Face value of the bond is given as rupees 1000. Coupon rate is 10% per annum. YTM of the bond is 9.6%. Maturity date is 31st December 2030. Last coupon date was 31st December 2024. Current date given is 1st July 2025. Determine the following. Market price of the bond on 31st December 2024. Full price or dirty price of the bond on 1st July 2025. Accrued interest from the last coupon date to the current date. And flat price or clean price of the bond on 1st July 2025. Now, solving this kind of question requires a very, very clear understanding about compounding. Most students, they commit errors over here because YTM is given as a 9.6%. And can you notice one thing? The price of the bond is not given. You will have to compute the prices, both the prices, that is the full price as well as the flat price. But to compute the full price on 1st July 2025, that is the current date, we must first determine the quoted price on previous coupon date, that will be 31st December 2024. So once you arrive at the quoted price on 31st December 2024, then you drag that value to 1st July 2025, that is to the current date. While doing so, keeping in mind one thing, 9.6% is the YTM of the bond given, and bond is making annual coupon payments. Use your common sense and tell me, is 9.6% per annum annually compounded or compounded for a different frequency? If question is given to you like this, how will you consider the compounding effect? Is 9.6% per annum compounded annually or for other periods? The obvious answer is it is compounded annually. Now use your common sense. We have a period of 6 months from the previous coupon date till the current date. How 6 months? Last coupon payment was made on 31st December 2024, correct? So it should be January, February, March, April, May and June. 6 months have lapsed. And now how many months remaining for next coupon payment? Other 6 months remaining. So the coupon period is 12 months and the period that has lapsed is 6 months. So the proportion will come as 6/12. Yes or no? 6/12 will be the proportion. 6/12 can be written as 1/2. 6/12 can be written as 1/2. When you are taking that as 1/2, you know what you should do? The annual factor with respect to the compounding, because your discounting rate is YTM, your annual factor will be 1 plus 9.6%, that will be 1.096. But because you have to consider the effect of the interest for half yearly, that means from the previous coupon date you are going to compound the value of the bond for the next 6 months. What many students do is they take the previous coupon date and to that they add what? Half of 9.6%, that is 4.8%. And that is a terrible mistake someone can commit. We cannot do that. Use your common sense of compounding. Let us assume the half yearly rate as I. Let us assume the half yearly rate as I, correct? Now use your common sense. If I consider I as half yearly rate, then in 1 year there will be 2 half years. So what should I do? 1 plus I raised to 2, correct? 1 plus I raised to 2 will become what? 1.096, because effectively your annual compounded rate is 9.6%. So 1 plus I raised to 2 will become 1.096. So if I want to find the value of 1 plus I, what will I do? I will take square root of 1.096. That means 1 plus 9.6% raised to 1 by 2. That adjustment, if you do not do, you will not be able to land up at the price on 1st July. Now, these tricky things you should be very, very familiar with, and you should be very clear with how to deal with this. Now, solving this entire question, how will you approach this entire question? Now tell me, has the question given any specific redemption price of the bond? Tell me, has the question given any specific redemption price of the bond? No. That means it is implied that the bond will be redeemed at par. At par means at its face value of rupees 1000. Check these things always. When you are reading a question, always look into the information clearly. So what will be your process of computation? First thing what you have to do is determine the price of the bond for the previous coupon date. As per this example, what is the previous coupon date given over here? 31st December 2024. What is the maturity date of the bond? 31st December 2030. So from previous coupon date till maturity date, what is the remaining tenor of the bond? Remaining tenor of the bond will be 6 years. Computing the present value of the bond's cash flow on that previous coupon date is a task of a kid. Anyone can do that, because you know the coupon payments, you know the redemption price. Convert all this into the present value, where the discounting rate is going to be YTM, and YTM will be 9.6%. Coupon rate is given as 10% per annum, means annual coupon payment will be 10% of the face value 1000. So annual coupon payment will be 100 and the redemption price will be 1000. All these cash flows you have to discount to their present value, where discounting rate will be 9.6%. You tell me one thing, can this be easily done or not? It can be easily done. The real new thing that you have learnt is about the computation of full price at the intermediate date, which in our example is 1st July 2025. So let us do one thing. Let us move step by step so that you are absolutely clear with all the calculations. So just quickly take the screenshot of this example if you haven't taken yet. And once you have taken the screenshot, let us start writing up the solution. The remaining tenor of the bond on 31st December 2024 is 6 years. Market price of the bond on 31st December 2024. How will you compute? Identify all the cash flows for the next 6 years. 100 will be the coupon payment and 1000 will be the redemption price. I have computed the present value factors for cumulative period of 1 to 6 years and at 6th year end. So this is the annuity factor from year 1 to 6. This is the present value factor for 6th year. I am going to multiply these respective factors to these cash flows to get the value of the bond, and market price of the bond on 31st December 2024 is coming to 1017.63. So now the next thing that we have to compute is full price of the bond on 1st July 2025. This is something crucial. So you are going to adopt the previous coupon date price, that is 1017.63, and to that you multiply the factor. But the computation of the factor, again and again I am telling you, what many students end up doing as a wrong calculation, they would be taking half of 9.6%, which will be an error. What you need to do is, you need to take 1 plus 0.096, that is 1 plus 9.6%, and whole raised to 1 by 2. Because if this is the half yearly compounding, then the annual compounding will be obviously this into the same thing, that means the squared of this. So power half and then multiplied to 2 will effectively give you the rate as 9.6%. So if you want to arrive at this half yearly rate, you should be always clear that it will be 1 plus YTM raised to 1 by 2. And from where did we get that 1 by 2? It is out of 12 months, 6 months have passed. Suppose out of 12 months, if 3 months would have passed, then you would have taken 3 by 12. If 9 months would have passed, you would have taken 9 by 12. Here 6 months have passed, so you are taking 6 by 12, and that makes it 1 by 2. Just for you to be crystal clear, let me remind you one simple logic once again. We don't know what is the half yearly rate, so we assume half yearly rate as I. So the factor will be 1 plus I, but 1 plus I is a factor for half year. For the entire year with semi-annual compounding, it will be 1 plus I into 1 plus I, that is 1 plus I the whole square, which should be matching with 1 plus 9.6%. 1 plus 9.6% is 1.096, which is the value equivalent to 1 plus I raised to 2. So if 1 plus I raised to 2 is 1.096, 1 plus I will be how much? It will be 1.096 raised to 1 by 2, or square root of 1.096. So you take the square root of 1.096, check with your calculator. On your calculator, what is the square root of 1.096? It comes to 1.0469. That multiplied to, so that is a factor, the factor multiplied to the previous date will give you the 6-month future value, and that comes to 1065.35. 1065.35. Please write up this whole calculation and then I take you ahead. Alright friends, once you have completed writing these calculations, let us move ahead and now make the remainder calculations, which is much easier. Accrued interest on 1st July 2025, very simple. 100 rupees is the annual coupon and half year has passed, so the accrued interest will be half of 100, that will be rupees 50. If it was any odd date, you would have taken the number of days divided by 365 or 360, whatever. That fraction of number of days you would have taken. But here it was clear half year, so we have taken half over here. Now we know one thing, that flat price is full price minus accrued interest. We already computed full price in the previous working. Accrued interest is known to you. So flat price can be computed as 1065.35 minus 50, that is 1015.35. So final conclusion is, on 1st July 2025, the dirty price or the full price is 1065.35 and the clean price which will be quoted in the market will be 1015.35.